All right. Why don't we go ahead? Thank you, everybody who has joined us here today, and welcome to Pivotal 180 and Adarite Legal's webinar on project finance and renewable energy PPAs. Before we begin, I'd just like to take a couple moments first to acknowledge the traditional owners of the land on which we meet, where all of us sit today, and like to pay my respects to elders past and present. And I also feel I'd be remiss if I didn't take a moment today, particularly for those of us in Sydney and around Australia, to acknowledge the events of last night in Bondi. I hope that each of you, your friends and loved ones, are safe, and wishing all of the victims their peace and healing in what are sure to be very difficult days to come. I want to take a quick moment then to introduce your presenters for today. So my name is Matt Davis, and I am a managing director for Pivotal 180 in Australia. Pivotal 180 is a financial modeling, advisory, and training firm, and we deliver both online and in-person training globally, including public and in-house courses. And we provide consulting and mentoring to modelers, advisors, and investors in the renewable energy and infrastructure space. I'm joined today by Graham Dennis from Adarite Legal, and I'll have Graham introduce himself.
Hi, I'm a lawyer, a specialist in energy law, well over 30 years experience in energy markets, energy trading, energy regulation. Um, I've done a lot of PPAs in my life, and other connection agreements and other contracts around energy projects.
Thanks, Graham, and very happy to be doing this with you here today. Appreciate you being a part of it. I guess I should say that aside from training, prior to my time at Pivotal 180, have also worked in project finance and project development in the renewable energy and power sector, both in Australia and in the United States. So, a bit of experience with what we're talking about today, and very excited to share a little bit about both my expertise and Graham's with each of you. Hopefully, find something useful to use in your own work. Give very quickly an overview of our agenda for the next 60 to 90 minutes. So we're going to be combining here in this conversation aspects of things that are important for project finance and how we raise financing, equity, and debt for renewable energy projects. And we'll start by talking about how project finance works, its corporate form, and the allocation of risk to all parties in those transactions. I'll talk a bit about the importance of cash flow forecasting as it relates to project finance, and in particular for non-recourse project financing, which is the most common type. Then Graham will speak quite a bit extensively about different structures and risks for renewable energy PPAs. In particular, what we'll focus on the Australian energy market and the national energy market, or sorry, national electricity market rather, that the NEM, and talk about different types of PPAs, different ways that projects can earn revenues, and the various risks and opportunities involved there for projects today. And then we'll bring that back full circle and talk about how choices that might be made in developing projects and in structuring and negotiating power purchase agreements, PPAs, for renewable energy projects impact those projects' ability and success in raising project finance debt and eventually impacting returns to equity investors. At the end, we should hopefully have some time for some Q&A for those on the line. You all should have access within the platform here on Zoom to type in questions in the Q&A box. If you look at the pop-up at the bottom of your screen, you should see a Q&A option. Please feel free to submit questions throughout the session. Questions that we see there, we may answer as we're going through it, if it's relevant to the conversation, or we can get to some at the end as well. So, with that, a lot to cover within the next just under an hour and a half now. As I mentioned, I want to start really by sort of asking a question. And that question could be asked in a couple of ways. That maybe the simplest way would be to say, well, what is project finance? But maybe in a bit more detail, what I'd like to ask is, if I were to present you a scenario where I said you had a project, a solar project, battery project, wind project, and you set up a project company to own that project. Within typical project finance, we have a concept that we call non-recourse financing. And the idea there is that while we have an equity owner, developer, IPP, project operator that owns the SPV, that project company. The goal is to raise debt often, and we'll talk about why we want to raise debt, but to raise capital and receive a loan from a bank or other lender, a sophisticated financial institution. And really critically, the aim is to raise that capital, raise that debt on what we call a non-recourse basis. And what that means is that the lender is going to make this loan to the project company, to the solar project or battery project or the company that owns that. And that loan will only be paid back, is only guaranteed to be paid back by cash flows that the project company via the project generates. In other words, if the project company and the project doesn't generate enough cash flow to repay the lender their capital plus interest, the lender has no ability to go to the owner of the project, no matter who that is, no matter whether that's Bill Gates or the King of England or anyone else, and say, hey, your project didn't pay me enough money, pay me back the rest. The lender's money and their loan is only secured by the project cash flows. And so maybe the broader question I want to ask is, how can you convince somebody, a sophisticated financial institution, to lend or invest millions or even billions of dollars in a project company and a project that has never operated before, never existed before? The project company likely has no employees, just been set up to own this project, and really critically is making no guarantee to repay the loan, right? Only if the project generates enough cash flow will it repay the loan. And in a nutshell, that is really what project finance is all about. And in particular, what we use project finance models of the type that we talk about and teach at Pivotal 180 and the contracts that we negotiate in relation to these projects are really designed to enable. Because for, say, a typical solar or battery or maybe co-located project, there's all sorts of risks that might exist, right? All sorts of things that could go wrong with a project and might cause it to not generate as much cash flow as expected, or possibly even cause it to not generate any cash flow whatsoever. And if the lender is concerned about those things, if they're too concerned about those things, then you can imagine they'd never be willing to make that sort of investment, a significant investment in that type of project where there's significant risk to the cash flows that are going to repay them. Now, the project company itself, as I mentioned, no operating history, no employees. It doesn't have any ability to manage the many, many risks that might exist with an energy project like that. And so as a result, what it wants to do, or what the sponsor, what the equity owner of the project needs to do on behalf of the project company, is enter into contracts with qualified counterparties who can help to create certainty and mitigate the many risks that go along with these projects. For example, thinking of, say, a battery project, right? Some things that the lender might be concerned about are, what is a project going to cost to build? Or how long will it take to build the project? When will the project be built? Project company can enter into an EPC contract with a qualified builder, qualified engineering company that can guarantee the cost to build the project and guarantee the timeline to build the project and guarantee that the project will be built and operating by a certain date at the cost that is expected of the owners and the lenders. Another question that lenders might have is, what's it going to cost to operate the project? If they're only going to be repaid by cash flows that the project can generate, they certainly are going to care what the costs to operate the project over time are going to be. There could be many costs to operate a battery project or a solar project. One of them could just be simply the cost to maintain the project, to fix things when they break, or to proactively service things so that they hopefully will not break. The project company is going to need to enter into a contract with an O&M contractor, right? Somebody who provides operations and maintenance services to the project. And that O&M contractor can provide a guarantee of what it will cost to operate the project, so there won't be any cost blowouts that might otherwise unexpectedly reduce project cash flows. They can also guarantee things like availability. They can provide guarantees that the project will be available to generate electricity as much as possible, or as much as is expected in the contracts and in the financial model. Our focus today is going to be on the other side of this sort of limited diagram here, on the offtake side. Projects very commonly, solar, battery, other energy projects, enter into power purchase agreements or other offtake agreements with a counterparty that is going to purchase electricity or purchase other things that that project might generate. And that's important because That's going to drive the revenue of the project. Probably the number one driver of cash flows of a solar project or battery project is going to be what are the revenues? And it's very difficult or maybe even impossible to accurately forecast the cash flows of the project in the future and the revenues of the project in the future if we don't know what the project is going to be paid for the energy that it produces. So we often enter into a PPA or other offtake contract to provide certainty of price. Certainty of price is going to be paid for energy, for every unit of energy that's generated by the project. And that can go a long ways towards de-risking the revenue that we expect the project to generate, and therefore the cash flow that we expect the project to generate, which the lender is able to be repaid by. Now, there's all number of risks that might come into play when it comes to a typical energy project. But for example, if we're thinking specifically about PPAs, power purchase agreements, like Graham will talk about, PPAs typically are very long documents, as Graham can get into, and they have all sorts of obligations on the project company, right? The buyer of the energy, that off-taker, wants some guarantees about what they're going to receive under the contract. So for example, the PPA is probably going to specify a required commercial operations date, a date by which the project must be placed in service. Well, thinking back to that chart on the prior page, who can provide certainty of the project reaching a certain COD, commercial operations date? The EPC contractor, right? Need that EPC contract so we know the project will be operating by a certain date. And we want to negotiate that EPC contract such that if the project isn't built on time, the EPC contractor will be the one financially responsible for it, right? If the project company is going to owe liquidated damages or other penalties if the project isn't built on time, let's make sure the EPC contractor is the one that has to pay for those things and any other costs or losses that the project incurs as a result, so that there's no impact to the project's cash flows if the project is late being built. Similarly, the project might have a requirement that it is available to generate electricity or provide electricity capacity, as Graham will talk about, a certain percentage of the time, or some sort of minimum delivery of electricity. Well, we rely on the EPC to have built the project to a certain standard. We rely on the O&M contractor to keep the project operating as well as possible. We can't, depending on the type of technology, solar or wind, we can't guarantee the sun shining or the wind blowing, right? But we rely on the contracts and on our contractors, our qualified counterparties who are equipped to manage these things to help us make sure that the project will be available as much as possible, will be able to generate the minimum required delivery of electricity and avoid any penalties. And if they can't, we want those penalties effectively to be passed on to the counterparty we wanted to pass that risk to, so that again, there's no loss in cash flows. Otherwise, that's a risk that the lender might not be comfortable taking, might be very difficult to have our project financed. And in a moment, we'll see why it's important that we get these projects financed or why we want to raise debt from lenders and therefore need to mitigate these risks. Overall goal here, right, is the project, which might otherwise, but project company on its own might have trouble doing this, is trying to create certainty of cash flow through contracts and credit worthiness, right? We're going to need certainty of cash flows if we're going to convince a lender to make a non-recourse loan to the project. And we do that through these contracts with our counterparties, with credit-worthy counterparties that we can depend on to make sure the project will generate as close to the cash flows expected as possible. Now, we can't be perfect here, right? We can mitigate the risk of the project being late being built, or the cost of the project blowing out, or operating costs blowing out, or the project not being available to generate electricity as much as is expected through our contracts. But there might be still certain things that are very, very difficult to mitigate, right? For example, what if we have these great contracts, but one of them fails? Our O&M contractor or our PPA off-taker goes out of business. Or what if the project simply produces less energy than expected because, as I mentioned, the sun doesn't shine or the wind doesn't blow as much as possible? What if there's a change of law or regulatory standards within the electricity market? There's always gaps. There are always things that we might not be able to mitigate via contracts. And in a way, it sort of makes sense, right? Because investors in infrastructure projects, while not expecting perhaps the sort of large-scale returns that maybe private equity or venture capital investors are looking to achieve, do expect to earn returns above what we might think of as the risk-free rate of return. And that means they're going to need to take some risks. Take some limited risks in order to achieve some return above, say, a risk-free rate. There are always gaps. We try to mitigate as many of these risks as possible via our contracts, but there are always things that remain. Maybe things that we can think of, like what if the sun doesn't shine as much as we think? maybe even things that we can't think of, like regulations or laws that could change we never could have imagined. And as a result, both lenders and equity do still expect to achieve some return, right, above what they might be able to achieve on a risk-free basis. Still, though, we want to mitigate risks as much as possible. We do that through our contracts, like the PPAs that Graham will talk about in just a few minutes. Now, going one step further, right, we want to mitigate these risks in the cash flows. We want to provide certainty of cash flows, and then we need to be able to model these cash flows, to forecast these cash flows, and forecast them in a well-built best practice financial model that we can share with our financing counterparties, like our lenders, and convince them that our view of the future cash flows is relatively accurate. Will never be perfect, but relatively accurate, and convince them that there's limited risk to those cash flows. And we think about the cash flows that we might model in a typical financial model for, say, a solar or a battery project. What are we talking about at a very high level, right? We're gonna have some very large upfront construction costs, and then hopefully fairly steady and predictable revenues and costs as much as possible. Probably very steady and predictable in our model. Only thing that's true about all financial models in reality is that they're wrong. They're a forecast of what might happen in the future, but we would like to have as little variation, hopefully from year to year, and certainly as much predictability as possible in these cash flows. And these are really long-lived assets, 20, 30, maybe even 50-year assets with really long-term contracts. Thinking about this maybe on a simple annual basis over time, what are we talking about? We've got some large upfront cost, right? A negative cash flow and investment. The CapEx of the project, largely dictated by that EPC contract. We need that EPC contract so we know what that upfront CapEx is going to be. Hopefully fairly steady revenues over time, maybe not exactly the same each year as we see here, but something like that, certainly predictable. That revenue dictated or predicated upon our offtake contract, our PPA agreement. And then hopefully also fairly predictable and steady costs over time that might eat into the overall cash flow, our revenue less our costs being the project's overall cash flows, dictated by our O&M contract, our other project operating contracts. Again, you can see how these contracts that I talked about are helping to provide certainty of the cash flows we're going to expect in the future and that we can share with our lender via our financial model. Now, if we take this one step further, let's say that upfront CapEx, that upfront expenditure of the project, was funded, say, 40% by equity and 60% by debt. I'll talk in a minute a little bit further about how we might get to those sorts of numbers, how we would figure out how much debt we could achieve for a given project, but for now, let's just take that as a given. If we have a loan in place to help finance a portion of the project, 60% in this case, that means we're going to have to pay the lender some debt service over time. We're going to have to pay them interest and principal return of their capital on their loan. And let's say it was a 15-year loan, we'd have to pay them some debt service every year. And that means that during the term of that loan, the time when that loan is still due to the lender, the overall cash flows that are available to equity are going to be reduced, right? Equity is only going to receive whatever is left over after the project's cash flows are used to, at least in part, pay debt service, the interest and principal due to the lender. Once the loan is paid off, equity will receive all of the cash flows, but equity doesn't get paid until after the lender gets paid. And project finance models, again, which are based on our contracts like our EPC agreement, our PPA, they're really, really helpful, well-built financial models for evaluating projects and for understanding a few things that probably our typical human brains might struggle to deal with, right? One of those is time. Right? Again, these are really long-lived projects with really long-term cash flows. And it's very common to see, for example, in a typical solar or battery project, the equity investor not maybe get their money back for many, many years, right? If they might have invested, if this was a $100 million project, investing $40 million, might very commonly not see equity get that $40 million back for 10, 15, however many years, often maybe around the time that the loan is repaid. One thing that a financial model that is designed in line with our contracts can really help us understand is, say, when will we get our money back? When will we break even in our investment? How much of our cash flow will come while we're paying off the loan or after we're paying off the loan or before or after things like our PPA have expired? That's a very difficult thing to do in the absence of a well-built financial model. And another thing that can really help us to evaluate is dollars, right? We can become very desensitized in the infrastructure business to large numbers. We say, oh, $1 million. What is $1 million difference? Let's say the cost of the project was going to be 100 million and now it's 101. Who cares? It's only $1 million. Well, it's important to put that into context, right? In this example, where we have equity funding 40 million of the 100 million, if the lender or if the cost of the project goes up by $1 million, as we'll see in a minute, the lender is very unlikely to help pay for that extra $1 million. Even if they're splitting this 160-40, what we'll see in a minute is that the amount that the lender is willing to lend to a project generally depends entirely on the forecast of the project's cash flows in the future, right? What cash flows it will generate from its revenues less its costs over time. If the project suddenly costs $1 million more, but the forecast of cash flows remains unchanged, the amount that a lender is willing to lend to that project is likely to be unchanged. And now we're not really talking about a 1% change in terms of equities costs, but a 2.5% change, right? From 40 million to 41 million. And imagine if the lender was providing 90 million and equity only 10, now we'd be talking about a 10% change from 10 to 11. Equity would be funding all of these excess costs. Again, why is it so important to have these contracts? That can cause a pretty big difference, pretty big impact on equities returns. And so with all of that, right, why do we need financial models, the kind of which we are talking about today and that we train people on at Pivotal 180? Well, again, really long-lived, complicated projects with long life cash flows, we're aligning the expectations of a lot of parties. We got to predict our cash flows, both to equity and to debt for a long period of time, and provide certainty of those cash flows, convince a lender that is risk averse and doesn't want too much risk in the cash flows they might be repaid with, that there will be significant or sufficient cash flows to repay them over time. Because that's going to determine for us how much each party is actually willing to invest. At a simple level, project finance can be broken down to something as simple as the more cash flows I'll receive in the future, the more I'll be willing to invest in the project today. And our financial model can help us predict what those are. Our model can help us quantify risks related to the project. What will it really cost us if the project isn't built on time? What will it really cost us in terms of lost cash flow or other penalties if the project isn't available to generate electricity as much as expected? Our model will help us determine core debt ratios. I'll talk more about that in a minute, but that's going to help us understand how the project is performing. And it'll certainly show our returns, right? Never see a financial model that doesn't include some expectation of equities returns. We want to see those in our financial models as well. Perhaps more than anything, a financial model, a well-built one anyway, can present outputs that we can use to help make decisions. What are our returns, but what are our risks, right? What is the worst case scenario and the best case scenario for our project? How do we show the work we've done, show our project in the best possible light, and make it relatively easy anyway for those that need to make a decision on investing in a project? And a financial model is very much I like to say, a garbage in, garbage out type of tool. If you have a well-built financial model, but it doesn't match the terms in your project contracts, like your PPAs, well, then it's not worth very much. We've got to make sure those things are aligned. Now, the last thing I want to talk about before I toss it over to Graham is why we borrow money in the first place. Because I think sometimes in project finance, we take it as a given that projects will raise debt, but it isn't quite as simple as we raise debt because we want to, or perhaps even because we don't have enough money to pay for a project. One thing we talk about a lot in Pivotal 180 classes is why we borrow money and what we call the benefits of debt, or the benefits of gearing, or where I'm from in the US, benefits of leverage, depending on where you are in the world. And in a really simple example, too simple for real project finance modeling or real project finance transactions, if we took an example of a 1-year project that cost $100 to build and could be sold after a year for $109, if that was built entirely with equity money, then clearly there'd be a profit to equity of $9, 109 minus the 100 they invested. And on a 1-year basis, returns are easy to calculate. A $9 profit on a $100 investment would be a 9% IRR, internal rate of return. But on a levered or geared basis, let's say we could achieve, like I had in the prior example, 60% debt. So we're getting 60 of our $100 from a lender. If they were to charge us, say, a 5% interest rate, perhaps a bit lower than market rates right now, but not too far, and the example would hold at, say, 6 or 7%. Now, while we'd still make the same $9 profit on exit, there would be interest expense of $3, right? 5% times that $60 that investment. So equity would not receive 9 anymore. They'd only receive $6 after paying that interest. But now equity's only invested $40. A return of 6 on an investment of 40, well, that's a 15% return. And so we don't just borrow money because we don't have enough or because we want to borrow money or because it's just handed down from on high. We borrow money for project finance transactions because equity investors achieve higher returns with debt, with higher gearing. And if that's the case, and there are exceptions to that, but in general, that is the case, then we need to know how much debt, how much gearing a project can achieve, and how much debt a project can achieve really depends on 3 core things. The first is something I'll call CADS, or cash flow available for debt service. The second is how much debt service the project has to actually pay. And the third is a ratio called the debt service coverage ratio, or DSCR. That last bit is very closely related to PPA terms and to risk related to a project. And I want to quickly talk about all 3, and then we'll talk about different PPA types and eventually how they might impact these things. So the first of these, CADS, cash available for debt service, really simply, for most projects in Australia as well as in North America, where we have something called pass-through entities, which really just means that the project company itself does not pay tax. We're talking about the revenues the project generates, less any cost, right? Maybe there's a little bit of interest or investment income, but what revenue do we generate? Probably via our PPA. And then what costs are there to operate the project? Our O&M, our insurance, our lease. Do we need to put any money away into reserve accounts, right, for future repairs, or do we need to perform any repairs or make any major capital expenditures? Those are important too. We're not talking about EBITDA or net income or anything like that, purely how much cash is there available that the project generates and that could therefore be used to pay the lender. In some countries that don't allow for taxable entities, or if the project company does have to pay tax, the only difference is that sometimes we need to deduct cash taxes paid from those CADs. But in general, really high level, not difficult to think of. We're simply talking about how much cash does the project have in its bank account at the end of every year, every quarter, every month that can be used to pay the lender. How much has it generated in that period? That's our CADs. That's our first piece of how much we can borrow. The second piece of how much we can borrow is debt service, right? And when I say debt service, I'm talking about the money we pay the lender. And really they're talking about 2 things: interest expense, interest that we pay on what we've borrowed, and principal amortization, repayment to the lender of the amount that we've borrowed. How much interest and principal we have to pay them each period is going to depend on the term of the loan, how long we have to pay them back. And a really simple example, again, debt service is just going to be the sum of those 2 things. Imagine I've got a $100 loan with 5% interest that needs to be repaid over 5 years, with that principal repaid in 5 straight line or equal installments. Each year I could calculate my total debt service by first calculating my interest as my opening balance times my interest rate. So in year 1, $100 times 5%, $5 of interest. And then my principal, if I'm repaying it in 5 equal installments, that'd be $20 a year, $100 divided by 5. That'd be $25 of debt service in year 1. At the end of year 1, I'd have $80 left. I've paid back 20. Year 2, I've got $80 to start, so I owe a little less interest, right? I only owe interest on the 80 that's left to repay. Still got to pay 20 of principal, same amount, $24 of total debt service in year 2. And we could continue on through the end of year 5. Very simplified example here. Simply pay interest on on the remaining balance of our loan, and we pay principal according to some schedule. In this case, a straight line, simple, linear schedule of repayment. So why do our CADs then and our debt service, the amount we have to pay, impact how much we can borrow? Well, it comes down to this third thing called the DSCR, or the debt service coverage ratio. Imagine I have that same debt service from the prior slide, 25 million in year 1, going down to 21 in year 5 as I pay the same amount of principal each year and a little bit less interest. And imagine I had cash flows or CADs of $60 million a year. My DSCR, my debt service coverage ratio, is just the ratio of CADs to debt service. So 60 divided by 25 in year 1, my DSCR would be 2.4. In year two, 60 divided by 24, my DSCR would be 2.5. And that raises the question of what is this thing? Have I just made this up? What is this debt service coverage ratio? Why do lenders care about that? Well, if you think about it, right? Imagine that in year one, we had 25 million of debt service, and we didn't know what our CADs were, but we knew that our DSCR was just 1.00 times, right? Well, that would mean that we had 25 million of CADs, 25 divided by 25 equals 1. And that would mean that the project has just enough money to pay its debt service. It's generating just enough to pay the lender. If the project actually generates even 1 penny or $1 less than expected in the model, it will no longer have enough money to repay the debt service. And when you think of it that way, it kind of becomes clear that DSCR really measures the risk of the cash flows or the health of the cash flows relative to the required debt service over time. DSCR of 1, we've got just enough money to repay the lenders. DSCR of 2.4, like we have in year one of this example, means that I've got cash flow to pay my debt service 2.4 times, right? I could lose a significant portion of my cash flow, of my expected cash flow. My project could generate a significantly less amount of cash flow than expected, and I'd still have enough money to repay my debt service, right? If I had 200, if I had 60, I could lose 35 of that, more than half. So in a nutshell, the DSCR really measures the risk to the lender. How much risk is there that the project won't be able to pay its debt service, because it measures how many times over the project can pay its debt service. And this DSCR is going to become very important because lenders use it to adjust for risk. Lenders actually set a DSCR that a project has to achieve, a minimum DSCR that it must achieve based on the risk that they see in the cash flows of the project. The more risk that they see in a project's cash flows based on the PPA and other contracts, the higher a DSCR they will set, because they'll want more buffer in the project's ability to repay its debt service. The lower risk they see, the lower DSCR they'll be comfortable with, and they'll set a lower one. And what we'll really see is that you could think of it the other way around, right? If we start with the idea that the DSCR is our CADs divided by our debt service, our principal plus interest, if we flip things around here, we could say that our debt service, our principal and our interest, just moving some figures around with algebra, would be equal to our CADs divided by our DSCR. Or in other words, the amount of debt service a project can pay to its lender over time is going to be equal to the cash flow it produces divided by the DSCR that the lender sets. So the higher the DSCR, the less the project will be able to pay to the lender. And pretty simply, that means the less it'll be able to borrow. Or the lower the DSCR, the more debt service it'll be able to pay to the lender, and the more it will be able to pay, or the more it will be able to borrow, rather. If we wanted to think about the total amount a project could borrow, the total principal it could repay over time, or the total amount it could borrow up front, its CADs that it's forecast to generate divided by that DSCR, less any interest it has to pay. You can imagine that the more CADs a project produces, the more it will be able to borrow. And the lower the project's DSCR, as determined by its risk, meaning less risk, lower DSCR, the more it will be able to borrow. Now, as I said a bit earlier, probably the number one driver of a project's cash flows is going to be its PPA and how it earns revenue from the energy that it produces. And there's a lot of different ways PPAs can be structured, particularly in Australia and in the NEM, that might provide different levels of reward, different levels of revenue, but also come with different risk, and lenders might assess them very differently in structuring loans. So I'm going to hand it over to Graham here, and he's going to share a little bit more about that from his expertise. And then at the end, we'll think about how the different types of structures he describes might be evaluated by lenders and therefore might impact a project's ability to raise financing from lenders.
Okay, thanks, Matt. So, looking at renewable energy PPAs in Australia, I think it's first important to understand that Australia is a little different than many other markets and jurisdictions. So, let's just understand that context. Australia has what we call a compulsory gross spot market. And that means that all electric energy entering the grid must be sold by a market participant to AEMO for the spot price. So you don't have a choice about who to sell your actual physical power to. If it enters the grid, it's purchased by AEMO at the spot price. And the corollary to that is that all energy leaving the grid must be purchased from AEMO by a market participant for the spot price. Now, in the Australian national electricity market, there are 5 regions and 5 different spot prices at any time, one for each region, and the spot price is set every 5 minutes. So, if you're thinking in historical terms about PPAs being the sale of energy, that's not really the case in Australia. In Australia, the only PPAs that involve the supply of physical energy from a seller to a buyer are typically those small rooftop solar PPAs where the seller is selling from the rooftop to the customer below, behind the customer's meter, or a sale of an adjoining project to a customer across the fence to a neighbour without the power going into the grid. And so both of those tend to be very small cases. Almost all grid scale projects in, rely on a different structure. They're not selling the physical power. The power goes to AEMO. And what we need is to guarantee the revenue for the project and produce that assurance that there's cash flow available. We need a contract structure that assures the generator of the level of revenue, even though the spot price is fluctuating every 5 minutes. So to do this, then, most PPAs that you'll encounter in Australia are cash settled over the counter contracts. I call them over the counter contracts because they're negotiated outside the market. They're outside the spot market and they're outside an exchange such as the ASX. They're an agreed contract. And so the great difference between a cash settled contract or PPA and a physical PPA is that the seller, instead of delivering a quantity of electric energy to the buyer, the seller pays to the buyer the reference price for electric energy at the required time for delivery. So it's a contract to hand over dollars, not a contract to hand over power. And handing over the dollars to the buyer gives the buyer a source of revenue for the buyer to purchase its required power from AEMO in the grid. So the parties agree some sort of reference price, and usually the reference price that they choose for a cash settled PPA in Australia is the AEMO spot price at the regional reference node for each relevant time period, which could be, say, every 5 minutes. Now, there can be variations to this, but typically the buyer and the seller will want to be in the same region of the NEM, and they'll agree that they settle against the AEMO spot price. So the generator is paying to the buyer the AEMO spot price, and the buyer uses that to pay for its power to AEMO. Now, there's a special clause in these cash settled PPAs that we usually call the net payments clause, and you won't find that in a physical PPA. And the net payments clause says that there are 2 amounts calculated. There's the amount payable by the buyer, which is typically the quantity times the contract price. And then there's the amount payable by the seller, the quantity times the spot price. And then the PPA then says you don't actually make those 2 payments. What you do is you calculate the net amount of those 2 payments, and the party with the larger amount pays the net amount to the other party. So under a cash settled PPA, you could find that it's the seller that's actually making the net payments to the buyer if the spot price is higher than the contract price. And typically in Australia, what happens is these net amounts are calculated every 5 minutes, and then they're added up and they're settled either on a weekly or monthly basis. So let's try and look at this then in a diagrammatic sense. Um, we'll put in this diagram the cash flows under a typical cash settled PPA. Now, firstly, I want to identify there are three parties in this diagram. We have the seller or the generator on the left. We have the market in the middle, which is the spot market operated by AEMO. And then we have the buyer, who's also a market participant but buys its power from the market. Now, I want you to look at firstly the brown lines. The seller actually sells its physical power into the market, and the buyer buys its physical power from the market at the spot price. And so the buyer pays the pool or spot price times the quantity of its load to the spot market. And the market pays the generator the pool price times what its generated quantity was. Now, these payments typically, they're calculated every 5 minutes and they're summed and they're paid to and from AEMO typically on a Friday, 4 weeks in arrears from the actual settlement trading interval in which the power was consumed or produced. And there is a proposal that next year this settlement period will be reduced to 2 weeks rather than 4 weeks. And that's going to go a long way to reducing spot market risk and liquidity issues. But for the present, let's just imagine then. So the seller is receiving the pool price from the market and the buyer is paying the pool price to the market. Now let's look at the two lines above, the red and the blue line. And these are the two lines that exist because of our contract, our PPA. And under our PPA, the first line, the blue line, says the buyer pays a bundled price times the notional quantity under the contract. And we'll get to what the notional quantity is in a minute. But that's basically your contract price for your PPA. The buyer pays on that blue line the price that they've agreed in the contract. And I've here called it a bundled price because in addition to getting the pool price paid back, in this case, the buyer also gets the environmental credits from the seller, which is in the green line at the bottom. So that's why in this case it's referred to as a bundled price. You've effectively got two contracts in one, sale of power and the sale of environmental credits. Now, the second line that occurs under the PPA is the red line. And this is what's the line that exists in a cash settled PPA and doesn't exist in a physical PPA. The seller pays the pool price to the buyer for every trading interval for the agreed notional quantity. Now, the notional quantity is the contract quantity that the parties have agreed they'll settle on. And it can differ. You'll see that the generated quantity is what the seller sells to the market, and the load quantity is what the buyer buys from the market. And the notional quantity is the quantity that they've agreed under the contract. But there will be a difference or an arbitrage or a differential if the notional quantity under their contract is different than the GQ or the LQ, and that will create different exposures. If you're a generator, typically you'll want the notional quantity to be as close as possible to the GQ so that your red line liability is matched by the line that you receive from the market. So let's then just look at how this structure then can play out in the terms of the PPA. I will mention that there are other names for these arrangements. We've been using the term PPA or cash settled PPA, but it's often called a corporate PPA if the purchaser is someone who's not a retailer. They're a corporate acquiring power for their own purposes. Generically, it's also called a contract for difference. And often we use that term when a government is writing these contracts, but it really is the same contract, whether it's a corporate or a government that's the party to the contract with the generator. Another generic term that people use for these is virtual PPA. So they're calling it a virtual PPA because there's no power transferred from buyer to seller. It's a cash settled arrangement, a virtual arrangement. Other generic terms that you'll hear for these include power price hedge, power price swap, power price derivative. And all of those terms are really accurate for the cash settled power purchase that I've described to you. Now, I mentioned that there was a critical component for determining the amount of revenue that the generator gets is deciding what quantity is the notional quantity under the PPA or the contracted quantity under the PPA. And there's four main models that are used for different types of projects and different types of situations. So the first of those common models is what I'd call a contracted profile. This is where the parties agree in advance what quantity their contract is going to reflect. So they might say, this is 10 megawatts flat for 3 years in every hour. That would be a contracted profile. Or they might say it's 20 megawatt hours for all the peak hours occurring in every week of the contract. That's another very common model. But these contracted profiles are really only appropriate for generators who are confident that they can dispatch the contracted quantity of energy. So it might be good for a gas generator or a coal-fired generator and maybe a battery or a hydro, but it's not very good for renewable energy projects who have intermittent quantities and quantities that vary according to their energy resource. So the second most common quantity model is what's most typical for a renewable energy generator. And that's what I call a generation following PPA, where the quantity is set every 5 minutes according to what the generator actually produced in that 5 minutes. So this presents an exposure for the customer because they might have need some certainty about their coverage for their power price and their load, but they're covering that the PPA only covers the quantity that the generator actually generates. So often customers who sign up to a generation following PPA have to have a secondary arrangement, some other balance of power arrangement to cover the power that's not supplied from the generation following. But the generation following is the most common model we use for wind and solar in Australia. And so the contract operates for whatever is actually produced by the generator. Now, the third type is what I call load following contracts. And this is where the buyer has some particular influence and the buyer says, I must have a PPA that matches exactly what I'm consuming. And so that's difficult for a renewable resource to follow, but it might be possible for a very flexible unit like a battery or some other dispatchable generation to write a PPA where they produce the same amount of energy as the customer is producing. And they'll need a data flow for that. They'll need to see the customer's meter in real time. And the fourth model that's less common but is around is a model that I call the buyer nomination model. And this is a bit similar to what most gas supply contracts look like, where the buyer says, look, here's what I need for next week or tomorrow, and I want you to produce according to that. So there's a broad range of power that the buyer can nominate for, and then it must deliver and tell the generator in advance, typically day ahead, this is how much I want each hour or each half hour, and the generator then has to generate to that structure. So that's quantities and the four different types. Let's now talk about pricing, because the revenue for the generator that it receives and is trying to secure is really quantity times price. And there are two main pricing models that are used in PPAs. The first model is what I call the production price model, where the contract says it'll be the contract quantity times a dollars per megawatt hour value. So this sort of model is typically used where the contract has fixed profile quantities or where it's generation following, and especially for intermittent renewables like wind and solar. That's the model. And so you'll hear, I wrote a wind farm PPA at $55 per megawatt hour. That's the sort of pricing model they're talking about. But the second model is what I call a capacity or availability and usage charge. And this is a fixed amount per day, often fixed amount per megawatt available per day, and then a separate usage charge for the actual dollars required by the buyer and sent out. Now, this is typically used where the buyer controls the scheduling of the plant. And this would be in, say, a load following quantity model or a model where the buyer nominates the quantity. And this gives the capacity charge gives the generator revenue certainty, that it knows most of its costs are covered even if the buyer doesn't order any energy. So the capacity charge is intended to cover those fixed costs of the seller having the plant available but not generating. Typically financing, depreciation, fixed O&M costs, but fuel is typically an excluded cost. The fuel is covered in the usage charge. So that's typically our common basic PPA model of having quantities and pricing. Now, what about the buyer who says, well, I've got a generation following model, but what commitment is the seller making to me about the amount of power I'm going to get? And so many buyers will insist on a minimum quantity requirement. So this requirement in the contract is usually where the contract applies to the seller's generation. So it's generation following, but the buyer says, I want you to commit that in a year there or a period, there is a minimum amount generated. You can't just sit back and not produce. Now, over what period do you calculate that quantity? I sometimes see monthly calculations and I see quarterly calculations, but in many cases, I think they're not really appropriate because we have such seasonality of generation in renewables, particularly wind and solar. So in my contracts, typically the minimum quantity requirement is typically tested annually. And then there is a requirement that the generator pay damages for failing to meet that amount. And those damages may be a fixed amount, what we call a liquidated amount. Liquidated just means fixed per megawatt hour of shortfall, or it could be unfixed. It could be calculated by some other reference, such as you compare the contract price to the actual spot price that the buyer would have had to pay in trading intervals where the generation was below the forecast profile. So this is compensating the buyer for having to pay the spot price when the generation was missed. And that's, in a sense, closer to the buyer's real damage. But it also exposes the generator to a higher amount of risk, because if spot prices are high when the generator is not generating, and that's often the case, then the actual payments payable by the generator are potentially higher. So a liquidated amount is probably more certain for the generator, though it might produce greater payments. A couple of other issues before I wrap up. Um, we often see provisions in the contract about negative spot prices. Now, most PPAs will cover the buyer against having to pay the spot price all the way up to what we call the value of lost load or VOL or the spot price cap, which is currently $20,300 per megawatt hour. That's as high as the spot price can go. And so if you imagine our diagram with the red line and the generator paying over the spot price to the buyer, that's the amount that the generator could potentially have to pay. And under our cash settled PPA, the buyer also has to pay the seller when the spot price drops below the agreed price. And so most cash settled PPAs will settle following the spot price all the way to the spot price minimum, which is $1,000 per megawatt hour. I have seen in the market some PPAs where the buyer says, I'm not going to pay you for the spot price minimum. I'm going to instead require you to shut down and not incur a minimum spot price. And so the buyer says, I won't pay you if the spot price, or well, I won't pay you for the difference if the difference drops below zero spot price. And then the generator is forced effectively to stop its generation during periods of negative prices. Now, I don't see that's a very rational or useful way because it exposes the generator to the risk of negative prices. And maybe 5 years ago, when these clauses were popular, people thought negative prices wouldn't happen very often, but they're happening very often for hours a day now. So that's unattractive. It's also not very rational because when there's a negative price, the buyer will actually be receiving money from the market if it has load. And so that's a source of revenue for the buyer to sell to cover the generator against the negative prices. So my message to generators is I would argue very hard against a clause which limits your coverage against negative spot prices. And lenders will be concerned to see if the PPA turns off when the price goes negative, because that's not giving revenue certainty. Now, just to wrap up, a few other clauses in a PPA typically that address other risks. There's the risk of late completion, and usually there will be liquidated damages payable for that. So that's an amount where the seller has to pay out the buyer for late delivery of the plant. Another risk to consider is the scheduling process. Now, I haven't mentioned this yet, but in the Australian market, all units over 30 megawatts must participate in a scheduling arrangement. They can't just turn on their plant. They have to submit a schedule to AEMO with a set of prices. And what most units will do is if they do have a PPA, they'll try and schedule their units at the most negative price, negative $1,000, because they want to be sure that they're going to be on and receiving that spot price. Some other issues that can impact generators: network constraints, congestion, network failure preventing dispatch. If you've got a generation following contract and the network is out and you can't generate, then typically that means lost revenue. And it's rare that you'll find a buyer who will compensate you for that. So that is a risk that generators in Australia have to factor into their revenue. In the UK, generators are paid constraint amounts for being turned off, but that's not the case in Australia. You've also got the insufficient grid load that even if you bid the minimum price, you may find that there's insufficient grid load and you won't be generated. So That's an issue that we're starting to see, particularly in South Australia. Of course, you've also got the weather resource unavailability, so lack of wind, lack of solar. If you've got a generation following plant that's exposed to renewable resources, then you've got an exposure to the weather resource. And the way this is typically dealt with in the financing is that the financiers take an assurance from a forecaster as to the likely weather resource available. And these forecasts are done at various levels of probability. I've seen forecasts at sort of an average availability, which is called P50, and then there's a P90 forecast, which is a high level of confidence that that forecast will be met. It's typically a lower quantity because there's a higher level of that being achieved. Other risks for generators include equipment failure, which you address through warranties and O&M assurances. Your PPA will also have clauses for late payment and default interest. That's your credit risk against your buyer. You'll typically also have a law change clause, especially to deal with environmental constraints, and you'll also have a tax rate change clause, probably to cover against changes in the tax rate, such as the GST. Just to touch briefly on the force majeure clause, which is often seen, this is done, this relieves a party from doing what it would otherwise have to do in certain force majeure events that are beyond the control of the party. And the relief that they usually provide is to the seller in relation to late completion or commissioning, the inability to operate or schedule its generation, or inability to meet minimum generation commitments. Typically, to get into relief for force majeure, the event that happens must be beyond control, not reasonably foreseeable, and not due to a failure to operate with good electricity industry practice. And for things like minimum generation commitments, it's very hard to get into that area of protection, because generally, if the plant is being operated properly, it should meet its minimum generation commitments or meet its schedule. There's usually a number of exclusions from the force majeure clause that don't relieve the seller, and they include labour disputes that are not industry-wide, any lack of finance, lack of weather resource, market conditions or prices, breach of law, or normal wear and tear, because you should be maintaining your plant against normal wear and tear. So force majeure clause does relieve some of the commitments of the generator where unexpected things happen, but you can't say that they tend to be the extremely unusual rather than run-of-the-mill sort of events. The other type of clause I mentioned, a change of law clause. This is also to protect revenue. It allows the generator claim an increase in costs for changes in law, regulation, license, all occurring after the signing of the PPA that weren't pre-announced. And it covers you for a change or in direct or indirect costs for operation. And typically the way it works is if there's a change in law, you look at what's the extra cost you've got over the balance of term of the contract, and then you NPV that back to present day, and then you look at the term of the contract and you apply the increased costs over the term of the contract. A lot of buyers often insist that this clause works mutually, that a change in law that reduced costs should also reduce the charges under the PPA. And some contracts limit the cost recovery to market average or spot price impact of the law change, not to the seller's actual position. So, for instance, if I'm a buyer contract with a coal-fired generator and the coal-fired generator says, I want you to insure me against a new law that imposes a carbon tax on me, Or the buyer might say, well, I'm not going to pay all of that carbon tax because if I didn't enter this contract with you, I could enter it with someone else and I wouldn't have that carbon tax risk. So I'm only going to pay you the effect of that I would be seeing in my own in the market generally, and not your special position. So that's something else that's negotiated. Um, Last two comments: early termination clauses. I try usually to try and avoid lots of triggers that would trigger early termination, and instead I try and make contract price adjustments to keep the contract going. Financiers usually will require an additional notice, an opportunity to remedy default. Sometimes extended force majeure can lead to a contract termination. And typically, a seller might want to be able to suspend the performance of the contract rather than terminate and lose the contract. If there is an early termination, you've got to put into your model an early termination amount. And I find that those early termination amounts tend to fall into four different events for four different calculations. One's where the seller's defaulted, one where it's terminated because there's been a force majeure, one where there's a termination because the buyer defaults, and one where there's a buyer termination for convenience. In the buyer termination for convenience, a lot of governments want this. I typically would insist that all the costs were paid for the plant. Whereas on a seller default, the seller's equity would likely not get a recovery in the termination amount. There's also a concept called two-way termination, where when the contract closes out early, um, either party has to make a payment. Whichever party is in the money is advantaged by the early termination. They have to pay out to the other party. This is very common in cash settled PPAs and other cash settled contracts. And it has the advantage of ensuring that a party doesn't just rely on an early termination to get out of what would otherwise be an unfavourable contract. It tends to keep the parties honest. So, just to conclude then, a PPA in the Australian NEM is very different to what would be the position of an IPP contract because an IPP in other countries where there's only one customer available, the generator only can't readily replace the contract or sell surplus power to another customer. But in the NEM, there is a continuous market here available to price excess or shortfall power and a somewhat forward market to price early termination values. So it's a very liquid market, the Australian NEM. There's lots of people to trade with, there's lots of people to set prices with. It's very different to the position where you're a lone independent generator dealing with a mass utility on the other side. Okay, well, I'm going to hand back to Matt now, and you can continue with your spreadsheet analysis, Matt.
Thanks, Graham. Really appreciate those insights. Certainly, I think the Australia and the Australian NEM in particular, a unique market globally compared to other global markets when it comes to the structures and the risks involved, simply because of the way the NEM operates, and that imposes perhaps different risks that both equity investors as well as, of course, lenders are going to have to consider when it comes to negotiating these contracts and what or how they're willing to provide financing for renewable energy projects or any project and any energy project in Australia. So in order to sort of bring things full circle based on the conversation we had at the beginning around project finance and cash flows, and then all of these details and the different risks that Graham spoke about and structures Graham spoke about with regards to PPA, I wanted to do a very short, sort of simple, high-level case study. Sort of think about how we might use a financial model or how we might use a financial model to assess the risks or benefits of a couple of different, perhaps PPA structures and terms. And what we know from what we've talked about so far, right, is that projects want to raise debt. We want to increase debt, increase gearing, because gearing increases equity returns. We also know that lenders care about risk, right? Lenders are going to be willing to finance a project or not willing to finance it, or they're going to adjust for risk using the DSCR, depending on how much risk there is to the forecast cash flows. And what I mean by that is, hey, what does the model say the cash flows are likely to be in the future? And what are the odds that it could actually vary from that, particularly in the downside, right? Lenders not worried about the project generating more cash flow than expected, but worried, of course, about the project generating less, not being able to pay them back. And then we also know from what Graham just discussed that there's a lot of different terms, a lot of different things to be negotiated in a PPA, which might affect how much risk, how much downside potential there is in the cash flows that a PPA-backed project is expected to generate. Now, we could take these things in all sorts of directions. We could look at a million different structures, but I want to sort of look at maybe two extremes, right? Imagine we've got a hypothetical project. Here I say solar plus battery, but it really could be any type of renewable project. Perhaps cost, just making some numbers up, $350 million to build, and has annual operating costs, fixed operating costs of $10 million. Very, very simple, straightforward assumptions here. Now imagine you're developing this project, you're negotiating some offtake, a PPA contract, perhaps just making up here a 15-year tenor, pretty typical tenor perhaps for maybe on the longer side for a PPA. And maybe you've got two options, right? You've got two offers on the table or two options that you may be negotiating. The first of those is what Graham described as a capacity-based PPA, right? Where the project is paid a certain dollars per megawatt per day or per month, really just based on availability of the project. Project receiving fixed monthly payments, subject only to the availability of that project to generate electricity. Whether or not the buyer buys it, it's available to them. And perhaps that contract might, in our model, come out to expected revenue of, say, $50 million per annum. Again, just some rough numbers. Then perhaps we have a second option that's a generation-based PPA. Again, for a solar plus battery project, maybe we could have an option to sell our capacity. We can guarantee there will be capacity thanks to the battery component. Or we could have the option to just sell our energy as it's produced, a generation following contract, where the project receives a fixed dollar per megawatt amount based on how much energy it actually produces. So now our payments depend on actual energy generated and sold. And perhaps, this buyer, the energy buyer, wants to negotiate some exclusions within the contract for curtailment or congestion losses, where there might be zero revenue, therefore, to the project if the project can't produce. Or they want to exclude negative pricing events, right, where the seller would receive the negative spot price instead of being able to sell under the PPA. There could be all sorts of other things that we might negotiate on there. As Graham mentioned, maybe spot settled delivery LDs. Of course, there's resource risk when it comes to a generation-based PPA that would not exist within a capacity-based PPA. But hey, more risk here. We're getting more return, right? $55 million per annum is the forecast in our model for this contract. Otherwise, project's the same, term of the contract is the same. Well, if we've got these two options, how could we use a model to determine which one we should choose, right? We could look at it two ways, right? First, we could start ungeared. We could say, what are the expected cash flows of this project before worrying about financing? And for option one, right, imagine 50 million of revenue per year. Apologies, trying to show 15 years, it's a little bit small. 50 million of revenue per year, 10 million a year of costs. We've got $40 million a year of cash flows or CADs. If the project costs $350 million to build, all funded by the investor on an ungeared basis, that would come out to an equity return, an IRR of 7.64%. That's for that capacity-based PPA. On the flip side, if we look at that generation following PPA, where we get paid on a dollar per megawatt hour basis, perhaps we forecast revenue at 55 million, as I suggested. Same costs. Our CADs are therefore higher, right? 45 million of cash flow per year. Same cost to build the project, 9.61% IRR with these higher cash flows over 15 years. We might look at that and say, well, 9.6 is a lot higher than 7.6, 2%. I definitely would take that. Option two looks better, right? But then we have to remember If we're going to be financing the project, and probably we are, again, because we know that we can achieve better returns with debt, how is the lender going to view these sets of cash flows and the risks associated with them? And what is that going to mean for their terms? If we think about this on a geared basis, capacity contract, very, very low risk, right? We've simply getting a fixed dollar per megawatt per month or per year, whatever the payment terms are. There's no generation risk, there's no performance risk outside of the project simply being available to provide capacity when the off-taker needs it. And in that case, the lender is going to be very confident about what those cash flows, those modeled cash flows might be. And therefore, they are likely to provide a fairly low debt service coverage ratio, DSCR, right? That ratio of the expected cash flows to the required debt service. The low end, right? Lenders might be looking at DSCRs in the range of, say, maybe 1.2. And what they then do is they take those future cash flows, as I showed with the formula earlier, those forecast future cash flows, they divide them by the DSCR. Well, 40 million a year, the 50 of revenue minus 10 million of costs, divided by 1.2 gives $33.33 million per year. If our interest rate was market-ish interest rate right now of around 6.5%, if we calculate out interest and principal, and by the way, this is something, sizing and structuring repayments, something we cover in detail in a lot of our Pivotal 180 project finance classes. What we'd see is that this project could repay a loan within that 15-year period based on that 1.2 times DSCR and 6.5% interest rate of $313.4 million. If we look at the interest and principal over time, we would see that loan pay off to zero perfectly over those 15 years. As you see, same loan size matches the amount of principal that's repaid. And if the lender would provide $313 million and the project cost $350 to build, well, then the equity would only need to provide just under $37 million of total capital, right? Whatever the lender's not funding. Providing that much upfront capital and then receiving whatever cash flows are left after we deduct that total debt service from the CADs, that would provide a 16.3% IRR on a geared basis. That's for that capacity contract with very low risk. We get attractive terms from lenders when we have low risk in our cash flows. On the flip side, option 2, which may have looked better in terms of generating more revenue, generating more cash flow, generating a higher return on an ungeared basis, when we look at that with debt, things might look quite a bit different, because if the project is subject to generation risk, if it's subject to curtailment and congestion risk, if it's subject to negative pricing risk, if it's subject to any number of risks that might apply to a generation-based contract, and again, all of these are negotiable. Not to say that every generation-based PPA comes with all of these risks, but certain things that buyers might like to do to protect themselves. Suddenly, the lender looks at that same forecast of cash flows and says, "I see a lot more risk in that cash flow per year than I did in the first contract." Where they saw an expected cash flow of 40 million a year in the first option, but with very low risk, they had 45 million a year expectations for the second option, but with a lot more risk. Well, how does a lender adjust for risk? They do it via that DSCR. They say, I need more buffer between your expected cash flows and what you're going to pay me. Now we divide 45 million a year, the forecast cash flow in option 2 by 1.8. That only gives 25 million a year of cash that we can actually pay to the lender of debt service, relative to 33 in the first option. So while this option provided more overall cash flow, the amount the lender will accept per year is a lot less. And that means we're going to be able to borrow a lot less. Now we're only borrowing 235 million instead of borrowing 313 million. We've lost 80 million almost of total debt. If anything we lose in debt sizing is capital that equity is going to have to pick up. Now for that project that cost 350 million, equity's got to pay for 115 million instead of just 37 in that first option. Investing that much more, a lot more money, investing 80 million more dollars is going to hurt equity's return. Even though they get a bit more cash flow per year in this case, equity's return now on a geared basis, 15%, a full percentage point lower basically than option 1. Less risk results in a lower DSCR, debt service coverage ratio, and a lower DSCR, depending on the difference in cash flows, likely to result in more debt and a better equity IRR with a lower risk contract. So there's trade-offs that we face all the time in terms of negotiating project contracts, PPA being a really critical one, that impact both the project's expected cash flows in the future as well as what the risks are to those cash flows. And we have to consider both in developing projects if we're going to be able to finance them successfully and optimize returns as equity investors. Now, a few final takeaways, and again, if anyone does have any questions, please feel free to put them in the webinar chat or in the Q&A. If neither of those are working for whatever reason, feel free to email me directly, matt@pivotal180.com. But a few key takeaways from our conversation today. With non-recourse project finance transactions, lenders are really laser focused on certainty in cash flows in order to reduce the risk of them recovering their investment. Higher risk is going to mean that they're going to need to have higher debt service coverage ratios, or at the extreme end, really high risk in forecast cash flows means they might not be willing to finance a project at all. Debt benefits equity, right? We borrow money because it increases equity's return on investment, as we just saw. Equity investors usually receive a better return with debt than without debt. Lenders are going to adjust for that cash flow risk via the DSCR. Less risk is a lower DSCR, and that's going to mean more debt. And PPA terms are going to very often be the major drivers of expected cash flow and risk for renewable energy projects. Certainly, there could be risk in operating costs, but typically operating costs for renewables projects are a small fraction of revenues. So risk in revenues, as determined by the PPA structure, are going to be the major driver of the quantum and the risk of project cash flows. That means project developers and owners should consider not only maximizing expected cash flows, but also minimizing and reducing downside risk when it comes to negotiating PPA terms. Of course, there's always trade-offs to be made there. As you can see, a well-built financial model can really help you to determine what are the trade-offs that we have there. What do we gain from a riskier structure or less risky structure, and what do we lose from those structures, and being able to compare and make informed decisions about how we contract, offtake, and anything else from our project. So with that, 5 minutes left. I'll open the floor up to Q&A. Again, if anyone has any, please feel free to submit it via the chat or the Q&A. If there's not any, I'll give everybody a moment, but if there's not any, that's all right. Graham and I will sign off momentarily. In the meantime, I do want to thank everybody for joining today. Really appreciate you taking the time. Hope everybody was able to learn a bit more about both financial models and risk and the structure of project finance contracts, as well as PPA contracts, and what's unique and specific to know about them within the Australian national electricity market, things that you can use within your own work. If you'd like to learn more, and I'll have Graham share the same, please feel free to reach out to sales or matt@pivotal180.com. I'd love to chat about our project finance and renewable energy financing modeling courses, where we cover topics like these and how we examine those within financial models in a way that enables us to make informed decisions about the projects that we're working on. Graham, anything else you'd like to add before we sign off?
No, I think it's been quite interesting to see how all those issues that I negotiate on the PPA flow through into the revenue and the returns. Yeah, fascinating to see the outcomes.
Thanks, Graham. Oh, we just have a question. Melinda, appreciate the note. Amit, thank you. How does the capacity investment scheme debt size, how is that different from typical PPA? Also, so on the slides, we will be providing a recording of this presentation. So everybody that's registered, whether they've attended or not, will receive a link shortly to the recording of this presentation. If you'd like something else, you can reach out to me individually, and I'll see what's able to be shared. Graham, I'd be interested in your thoughts here. At a high level, in terms of the CIS. What the CIS really critically does is it provides a floor on revenues, right? Obviously, had to be bid by the project companies or by the investors looking to achieve it, but providing a floor on revenues is going to be critical for lenders, and really viewed favorably by lenders, saying, if I've got a minimum amount of revenue, then I've probably got a minimum amount of cash flow, and that means at least for that amount of revenue or cash flow, I'm probably willing to provide a very low debt service coverage ratio and provide a significant amount of debt relative to the amount of those cash flows.
And I think the other thing about the CIS is that you've got government creditworthiness. So most PPAs, you've got to assess the creditworthiness of your off-taker, particularly their ability to sustain that over, say, 15 years. The CIS, because it's government credit, it reduces the lender's risk significantly. But it probably still leaves open the resource risk. It doesn't drive that one away. And also risks like performance of the plant and over the long term, which you might cover with warranties. But certainly the credit risk of the government certainly enhances the financing. And then in turn, that means the ability to either get a higher level of gearing a or a better margin on your loan.
Yeah, I think that's well put. Creditworthiness is a really important thing, right? These are long dated agreements, partnerships, really a PPA. Certainly don't expect that the Australian government will be going out of business. No real risk of failure of that contract over a long period of time. And this was a very high level analysis that I did at the end of the presentation, but it's certainly possible that you see contracts with multiple revenue streams, right? Maybe some from capacity that's more of a fixed downside floor, as well as some, say, generation revenue, maybe FCAS or other ancillary services revenues. And lenders might evaluate each of those separately, right? They might say, we'll provide some debt based on the very certain capacity downside revenues, and maybe some higher DSCR debt based on some of those riskier revenue streams, like, for example, energy arbitrage in the market or FCAS services or things like that. Well, if there's no other questions, again, I'll just thank everyone once again for joining today. Really appreciate your time. If you have any questions afterwards, please feel free to reach out to either of us via email. Look out for a reminder for the recording availability of this session. If you have any colleagues you'd like to share it with, we really encourage you to do so. And please reach out if there's anything else you'd like to know about project finance and PPAs and any other topics related to renewable energy and infrastructure. Have a great rest of your Monday and a fantastic holiday season.